Hey guys, I wanted to send you this quick video update because of an important market development. Talk a little bit about adaptive performance, but really highlight this important market development that took place this last week. The most efficient way to do that is for me to send you pictures and record this. I'm going to try to keep it less than 10 minutes because I know your time is valuable. And so we're going to jump through this right away with not a lot of introduction, but this last lunch and learn that I gave, the presentation was called 500 Days to Nowhere. A lot of the images used were regarding roller coasters because roller coasters go a lot of places but nowhere, right? We can hop on them, they go up, down, sideways, and then we're back at the same place. That's basically what the market's done over the past almost 2 years. To drive that point home, I have some charts here of some very popular indexes and stocks, bonds, some commodities overall. For example, just to orientate yourselves, these top two charts are probably of the top two most popular indexes in the world. The Dow Jones Industrial Average, that's the one they talk about on TV the most. That has about 30 stocks in it. Here's January 2018. The chart goes back to October 2017, but here's January 2018 from this point forward. The market's only risen about 1.7% over 21 months. It had an 18% correction during that period. Same thing, S&P 500 stocks since January 2018 has moved about 3.2% over 21 months with a 20% correction during that period of time. We were able to protect portfolios during this period of time. We've been more nimble. We were able to protect during this fourth quarter. But what this is driving home is obviously 1.7% over 21 months is nowhere near equal to what you might read in a textbook or hear on the media about the average return of the market being about 7.5%. That's very similar to saying, and I always give this example, that if I were to walk out of the house on January 15th, that I should expect it to be 48 degrees in Wisconsin. We all know that the average temperature in Wisconsin is dictated by extremes, by the temperatures in summer and the temperatures in winter. Same thing in markets. The average is dictated by extremes. There are always periods where there are major corrections, where there's 1 out of 5 years a 10% loss or greater. Same thing in up. When there is big up years, those happen about once every 4 years. There's about 20% gain or greater, and that's what dictates the average. To drive home even more the point of what's been going on for the past 20 months, almost 24 months. Here's the New York Stock Exchange. This has over 2,000 stocks in it, so much broader than the Dow Jones or S&P 500. Since January 2018, minus 5.5% over 21 months. Also had a 21% correction. Russell 2000, this represents 2,000 domestic stocks, small caps. January 2018, minus 6.8% over 21 months with a 27% correction. These are all the stocks. This is an all-world index, minus 14% over 21 months, and at the bottom, minus 23%. China, I think I'm driving home the point here, minus 23%. Japan, Europe, Latin America, you get the point. Treasuries, that's one bright spot, 22 months, plus 10%. But I'm driving home the point. Corporate bonds rolled over early or late 2017, actually, minus 2.3% over 24 months with a minus 10% correction in there. Oil, same thing. Gold, we have held positions in this from time to time and do so currently. 21 months plus 9.5%. Silver, approximately flat. If there was any chart that you were going to look at that I could drive home the point of what's been going on with the market, I would use this one. This is the All World Index. This has over 8,000 constituents in it, meaning it's a much broader basket. It represents what's going on in U.S. markets as well as the world. It's the total world index, and it's much more significant than the S&P 500 and the Dow Jones. You can see that since January, we're still below where we were in January 2018, but really, we have not been able to get above this shaded area for over 20 months. Sellers keep showing up at the same spot. In fact, the full correction that took place that was down here Christmas Eve. Now we were protecting your accounts back in here, avoiding this major correction and then scaling back in here. But you'll notice that this correction all the way to Christmas Eve wiped out all of 2017 gains. That's not something that happened to adaptive portfolios. We were able to protect gains. In fact, it had a positive return in 2018. We've since been scaling back in, and now the market has churned sideways like this, which has also had an impact on portfolios. I know I had 2 meetings this week where clients mentioned, they noticed their account had been flat. And I just highlighted and showed them this, that absolutely correct. We have to deal with the market that we have. We've seen the market move sideways. In fact, we've seen it move sideways for over almost 2 years. But I do want to highlight something here later in this presentation, something very important that just took place. But if you want to see this in a much bigger way or get a deeper explanation, I provided the other video link in my email where I go through the hour-long presentation from the Lunch and Learn. Again, this one is meant to be shorter. If you remember, looking back again, we moved kind of sideways here for this period of time, April through now. And now, if you remember how the adaptive system works, right, orange below blue, we're going to protect accounts. Orange above blue, we're going to participate. And this takes place over and over, where about 10 to 12% of the time, adaptive will underperform. And this happens in period where, if you think about this, we're protecting accounts here. The market drops. In this case, this was 15 and 16. The market dropped about 18%. When we come off a bottom, if we're holding cash and the market is rising, we're unapologetically behind the market because we're not going to try to pick a bottom or try to catch a falling knife. To try to drive that point home a little bit more, here are some charts that go back to 1965. This is comparing just buying and holding the S&P 500 versus being adaptive with the S&P 500 using our orange and blue rules. And we can see that if we buy and hold the S&P 500, it has about a 3,400% return. If we were to use adaptive, it has about a 4,000% return. But even more importantly, when we look at what are the maximum drawdowns or the biggest corrections that take place within that process, if we buy and hold the S&P 500, we just listed the top three. The top three maximum corrections are minus 43, minus 48, and minus 54. Dramatically different if we are using an adaptive approach, okay? What I want to drive home here is, again, to orientate yourself, we're looking at 1965 to present. The blue line is how adaptive performs. Okay, now I want to zoom in to this period here, and we could have done this with any period, but I'm gonna drive my point home with this. This is 1965 to 1985. Again, we can see the blue line. It's in the best interest of our clients to use orange and blue to protect from these major drawdowns, such as what happened in 1974. Now, if we look at even shorter periods of time, again, here's 1965 to 1985. We see the blue line working, and we see adaptive working in bigger pictures. Now let's just zoom in on this period here. Let's just look at this window, which is represented here, December 68 through May 71. Okay, we can see adaptive protection going into place somewhere in summer of 69, and we can see that we're protecting accounts, and then we are able to participate again. But if you look at this window, this is a 1-year period, okay? We should be protecting accounts, right? We should be holding cash here because that's what the system is meant to do, is protect from major drawdowns, okay? But we're never going to be able to pick the exact bottom. So when we approach bottoms, or we look back 1 year from bottoms, there are periods that can look like this. And this is from May 1970 to May 1971. This is what the performance looks like, right? Flat for a little bit, and then we participate. So this is what I mean by being unapologetically behind, and that's because we don't manage based on 1 year, okay? We want to manage based on what's in the best interest in 3-year and longer periods of time. And we've shown the data shows that it makes sense to do that. So if we get just too focused on the short term, which would be like 6 months to a year, that might not be the best approach. I would equate it to, if you just watched the third game of the World Series, which Houston won 4-1, and you made your assumption on what happened with the World Series overall based on that game, that would be an incorrect assumption, right? The Washington Nationals won. We have to watch bigger pictures, not just 1 year or 6 months, to understand how a system works. So I just wanted to point that out. But most importantly, I wanted to highlight something major that just took place this last week, something stocks haven't done in almost 2 years. So you might be remembering this chart I showed you earlier, where we see the sellers kept on showing up at the same place, right? We can see that. We can see how at this, we'll call it 7650 level in this index, which represents over 8,000 stocks across the planet, including the US, selling, 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 selling. And this has been going on for almost 2 years. We've had this flat market. It's been a very frustrating market. Remember, we talked about how this type of market is more like being able to drive 65, 70 on the highway. This type of market, there's a lot of shifting and braking because there's more risk than reward in this type of market. In this type of market, which has a trend, there's more reward than risk. In this type of market, there's more risk than reward. However, from hard markets, from frustrating markets come easy markets. And that's something I really wanted to show you guys is this week, we broke that level finally. We've worn out all these sellers. The sellers did not show up. More buying pressure drove prices up. And so regardless of what the media is talking, whether they're talking about recession, trade wars, impeachment, whatever, we'll let the media do their job and we're going to do our job. And right now, this is evidence that globally there is risk appetite for assets and your portfolio is positioned for that to take advantage of this. We do believe this begets higher prices and that we will be heading back onto the highway and it can put the cruise control on at 70 miles an hour. This is a significant development. Your portfolios are positioned for that. We made those moves last week. In addition, if you use our 401k guide product because your funds are within your 401k, we did send out those updates this week and this weekend. So please look for those and please make the changes because this is a new development and we believe the next leg in a bull market is coming regardless of what the media says. We're making new price highs. Now, all that being said, we do have our risk management plan in place. If we're back below this level here, this price level, we're definitely back in more risk than reward mode. But right now, this new move is the first time in almost 2 years that there is now more reward opportunity than risk apparent. So accordingly, your portfolios have been positioned that way. So with that, I want to conclude this. I know I've gone over my 10-minute mark, but we're always going to stay disciplined to the system. We're going to invest with the direction of the trend. We believe we have a new uptrend upon us, which we can take advantage of, and we're going to stay disciplined. As always, call us. If you have questions about this or you have questions about your portfolio, feel free to call us 262-335-1700, or you can email us, my team at clientfirsttaxandwealth.com. We'd be more than happy to either talk with you on the phone or schedule a meeting and have you go through any questions you might have. But other than that, I hope you guys found this information useful. We are positioned for this next move, which we believe is higher. We also have our risk management in place. So I hope you guys found this informative. Take care. Have a great rest of your weekend.